Welcome to our introduction to accounting. In this video, you will learn just enough accounting to be able to start learning QuickBooks. If you're new to QuickBooks, then you may ask, what is accounting? Well, to answer that question, I'm going to tell you a little story about my good friend Holden, the wedding video guy. Holden is a wedding videographer, and Holden offers two different services to his customers. Holden offers the video service, which means he can physically go to the wedding and record the wedding with his very expensive camera. And the other service that Holden offers his customers is editing service. This means somebody else could video the wedding and he could edit it in a professional way, burn it on a DVD, or put it in any format the customer wants. And that's going to be our example company. Holden was doing a great job running his business, and then one day his wife came to him and asked, "How much money did we make?" Guess what? Holden didn't know. He knew his customers were happy. He knew he was great at making and producing these videos, but he did not know how much money he made. Of course, he did not want to anger his wife, so he gave her an answer. So he said to his wife, "Okay, Renee, we made $30,000. He thought she would be satisfied if he told her one and only one number. But you see, that would not satisfy anybody if it was also their own business that he was running. So she further asked, "How did I get that $30,000? And in fact, how do you even know if 30,000 is the correct number?" Well, how would you figure out how you got that $30,000? Holden's wife, Renee, needed to explain to him that in order to know if he really made $30,000, he would have to first figure out the total money that came in from his customers. He would then have to subtract the total money that he needed to pay for all the goods and services that gave him the ability to earn the money from the customers. For example, let's imagine that the money that came in to Holden from customers was $1,030,000. However, let us imagine that in order for him to earn that $1,030,000, he needed to spend $1 million on goods and services. Do you think if these were the numbers that caused him to have $30,000 at the end of running his business, do you think that Holden's wife would be happy? Well, most people don't think so, because it means the amount of money that he kept at the end was such a small percent of the money that came in from the customers in the first place. However, if he told his wife that the reason he made $30,000 was because the total that came in from the customers was $35,000, and he only needed to spend $5,000 on goods and services to be able to serve the customer and earn the $35,000, do you think in that case Holden's wife would be happy? I think yes, because in this second example, the amount of money that he actually kept is a very large percent of the amount of money that he actually earned from the customer. So you see, it's not enough to just know the total. You have to know how you got that total and how much money came in and how much money went out. Now, of course, you could understand his wife's point. If this were a business that you were involved in, you would want to know even more information about that information. For example, how do you know how much money came in? Well, in Holden's example, he offers two services to his customer, so all he would have to do is find out the total money that came in from video jobs plus the total money that came in from the editing jobs. Well, then how would he know how much money went out? he would have to find the total of each of the expenses that he has. He would have to find the total that he paid for electricity, plus the total that he paid for telephone, plus the total that he paid for repair, and of course, plus the total he paid for transportation. And if he added up these four expenses, he would know the total money that went out. Knowing the total of each of these individual items will help you figure out the total money that came in and the total money that went out. So, let's imagine, for example, we know the total money for each of these 6 items. Let us imagine, for example, that the total money that came in just from video was $20,000. Let us also imagine that the total money that came in from editing was $15,000. Let's imagine the total Holden paid for electricity during that same period of time was $1,200. Let's imagine the total he paid for telephone was also $1,200. In fact, to keep the example simple, let's imagine that the amount he paid for repair and the amount that he paid for transportation were all $1,200. This will be easy for us to remember the individual amount of each expense. If Holden only paid 4 expenses and he paid $1,200 for each of his expenses, it would be easy for him to calculate the total of all the money that went out. So if this were his condition, then you would know the total money that came into the business was $35,000, which was the result in our good example, and the total money that went out of the business was $5,000, which was the total in our good second example. That means that we now have an explanation as to why the total money that Holden made in the business was $30,000. Now, it might seem like every time you answer a question, that answer opens up another question. So Holden's wife needs to know, how did you find the amount of each number in the first place? How did you account for each of these 6 items so you know that the total of each item is correct? Well, Holden knows the correct amount of each item because each item has something called an account. An account is a record of transactions. Transactions are the events that cause us to have the item in the first place. And each of the items listed here, each of these 6 items, the first 2 were income, the last 4 were expenses, but each of these items has an account, a record. Somewhere there's a physical piece of paper that looks similar to the picture you're looking at here, and on that piece of paper, Holden records each piece of information about the transaction. For example, let's take the first item on the list, video income. Let's imagine the picture you're looking at now is a piece of paper somewhere in a notebook, and every time Holden earns video income by performing a service, he would write down the details of that event here in the video income account. For example, let's imagine on January 15th, Holden made invoice number 22 for a person named Joe Schmo. The item of service that he gave was videoing the wedding, and he charged Joe Schmo $5,000. This is the way that transaction would look if he recorded it in his video income account. Let us also imagine something similar happened on January 18th, where he had to write up another invoice for a different customer for doing a wedding video job, and he charged that customer $5,000. This is the way both of those transactions would be recorded in the video income account. If it happened again on January 20th for a customer named Betty Boop, this is the way that transaction would be written down and recorded on the paper called video income. And finally, let's imagine on January 22, he did another video job for Candy Charles, and he charged her $5,000. If these were the events that happened, and this is the information about those events, then at the end of the month or the end of the year, Holden could add up the total money that came in from wedding videos, and then he would know the correct amount of money he earned just for doing wedding videos was $20,000. That's the same $20,000 that we told the wife we earned from video income in the previous example. So that's how Holden knows he made $20,000 from doing wedding videos. Now let's take a look at an example on the other side. Let's imagine that the picture you're looking at is the repair expense account. And let us imagine on January 16th, Holden received bill number 22 from Rex Repair Shop for replacing one of the lenses in his camera, and Holden needed to pay him $300. Let's imagine on January 19th, Holden got a bill from Donna's Electric for fixing a soundboard. Let's also imagine on January 22, Holden received bill number 24 from Midas to put on a new muffler on the company car in order for him to be able to use the company car for business. And finally, let's imagine on January 25th, Holden received bill number 25 from B&H Camera Shop for rewiring one of his cameras. And if he wrote down all the information every single time he paid for a repair, then he would know with certainty that the total amount that Holden paid for repair was $1,200. That's the same $1,200 for repair expense in our example. So that's how Holden knows the total money that he paid just for repair expense. In the days before the computer, each account was put together in a book called the General Ledger. The General Ledger was a book like a notebook. Each page in the General Ledger was a separate account for each of the items that the company needed to keep track of and account for. Now that we're using the computer, the General Ledger has a different name. It's still the same idea where you have a separate page or a separate record for each of the items that you have to account for. The difference is, if you're using a computer, you don't call the set of accounts the General Ledger. Instead, you call it the Chart of Accounts. Doing accounting means recording the transactions into the General Ledger. After the transactions are recorded in the General Ledger, they have to be organized and summarized onto official documents that would show the results of the business operation. The name of the documents that show the results of the business operation are called financial statements. In a few minutes, I'm going to show you what Holden's example financial statements would look like. But first, let's discuss what they show and whom they show it to. Obviously, they're documents that answer two questions. The first one is what his wife was asking, how much money did we make? And of course, we have yet to discuss the second question that they answer, where is our money now? But again, before I show you what they look like, let's first discuss who usually looks at a company's financial statements. Well, if Holden wanted to ask someone else to invest in his business, to become a part owner, obviously Holden would have to show that person his financial statements so that person would know how well Holden is doing financially and make a judgment, give an opinion, and make a decision about the business. If Holden wanted to borrow money to increase his equipment and his advertising in order to make more money, The people whom he borrows the money from would also need to see his financial statements so they can make a judgment about how strong he would be regarding his ability to pay it back. There could be other people or other organizations that might need to see a company's financial statements, but remember, the information on these documents all comes from the general ledger. Now, before I show you Holden's financial statements, let's discuss that other question that came up. Where is our money now? For example, if you're doing accounting, one of the things you need to know is what is the balance of the company bank accounts or any of the petty cash that the company has on hand. If you're doing the bookkeeping and accounting, you also have to know what is the current value of any of the company's assets, like the company car. Or in Holden's case, what is the value of the equipment that he uses? That's also financial information that accounting has to account for. Another way of answering the question, where is our money now, is figuring out how much we owe and whom we owe the money to. Well, the general ledger has an answer for that. Each bank account and each credit card account must have its own separate account in the general ledger. These are accounts that are in the general ledger along with the other accounts that we were just talking about. This picture is a little bit more like the way the accounts would actually look. Of course, it looks slightly different than the picture of an account that I showed you just a few minutes ago. In this case, the format of this general ledger account has two lines for every one transaction, a white line and a green line for this transaction, and then the next transaction is on a white line and a green line. But even though one transaction or one transaction's information is spread out over two lines, it still has the same information that we were recording a minute ago in the account that I showed you. It still has a place for when, who, what, why, and how much the transaction is. This type of format was popular in the days before the computer, and it looked like a book called The Bank Account Register. Now I can finally show you what these financial statements would look like. The two most common financial statements are the income statement, shown here on the left, and the balance sheet, which I will show you in a moment, here on the right. If you look here on the left, you can see that the income statement is sometimes called the profit and loss. It basically compares the income to the expenses so that you can see how well the business did during a particular period of time. And obviously, these are the numbers that would go on Holden's income statement if the numbers in Holden's situation were the same as what I showed you in this video. So the statement on the left answers the question, how much money did we make? To be able to answer the other question, how much money do we have, we look at the balance sheet. The balance sheet lists the assets of the company on the left side. So any of the general ledger accounts that represent an asset would have their ending balances listed here. For example, if the ending balance of the bank account were $500, that's the way it would be listed on the balance sheet. The balance sheet would also have an account for the petty cash account taken from the general ledger. And if the ending balance of petty cash were $500, that's where we would list it. The left side of the balance sheet lists the value of any of the company's assets, and all of the company's assets should have a separate account in the general ledger. If you add up the left side of the balance sheet, you would know the total value of the company. On the right side of the balance sheet, we record the liabilities. This is money that the company owes. For each credit card account, we have an account in the general ledger where we can look at the ending balance and know the total money we owe for that credit card. Any other money that we owe should have a separate account in the general ledger where we can look at the ending balance and find out the total money we owe in that case. The other item that goes on the balance sheet is something called owner's equity, which we will not discuss here. Now, these two financial statements that you're looking at are simply abbreviations, short summaries of what the documents would really look like. But at least you can see the idea. If we look at a company's income statement, we know how well they did and how much money they made. If we look at a company's balance sheet, we know what the value is and how much money they owe. But remember, all of the numbers on every financial statement comes from the ending balance of each account in the general ledger. And now we know why we do accounting. We answer two simple questions. How much money did we make? And where is our money now? Congratulations. You now know just enough about accounting to be able to start learning QuickBooks.